Understanding credit risk, mitigating risk for financial stability. Presentation overview, defining credit risk. We'll start by defining credit risk and examining the different types of credit risk that exist in financial institutions. Impact of credit risk on financial institutions. We'll examine the impact of credit risk on financial institutions, including case studies of credit risk events that have occurred in the past. Principles of credit risk management. Finally, we'll explore the principles of credit risk management, including credit risk assessment and mitigation strategies that financial institutions can adopt to manage credit risk. Definition and types of credit risk. Default risk. Default risk is the risk that a borrower will fail to repay their debt. This type of risk is often associated with high-risk borrowers or those who have a history of defaults. Credit spread risk. Credit spread risk is the risk of losses that arise from the difference in interest rates between a high-quality borrower and a lower-quality borrower. This type of risk is often associated with bonds and other fixed income securities. Concentration risk. Concentration risk is the risk of loss that arises from having a large exposure to a single borrower or a small group of borrowers. This type of risk is often associated with banks and other financial institutions. Definition of credit risk. Credit risk. Credit risk is the risk of loss that arises when a borrower fails to make their debt payments. This risk is influenced by factors such as borrower's financial status, payment history, and creditworthiness. Impact of credit risk on financial institutions. Credit risk is a key consideration for financial institutions as it can impact their profitability and financial stability. Institutions that do not manage credit risk effectively are more likely to experience losses and financial distress. Types of credit risk. Default risk. Default risk is the risk that a borrower will not repay a loan or meet other financial obligations, causing financial losses for the lender. Credit spread risk. Credit spread risk is the risk that a borrower's credit rating will deteriorate, resulting in an increase in the yield spread between the borrower's debt and benchmark rates, leading to losses for the lender. Concentration risk. Concentration risk is the risk that a financial institution's exposure to a particular borrower, industry, or geographic location may result in significant losses due to adverse events in that sector. The impact of credit risk on financial institutions. Credit risk and profitability. Credit risk can have a significant impact on the profitability of financial institutions. When borrowers default on their loans, financial institutions may suffer losses that can negatively affect their bottom line. Credit risk and financial stability. Credit risk can also impact the financial stability of financial institutions. If a large number of borrowers default on their loans, financial institutions may face liquidity and solvency issues. Credit risk and banks. Credit risk is a major concern for banks as they have significant exposure to loans. Banks must manage credit risk carefully to maintain their profitability and financial stability. The effects of credit risk. Credit risk and losses. Credit risk can lead to financial losses for institutions such as banks, impacting their earnings and capital. This can even result in the failure of the institution if not managed properly. Example of credit risk. Subprime mortgage crisis. The subprime mortgage crisis was a credit risk event that occurred in 2008, leading to a global financial crisis. It was caused by widespread mortgage fraud and risky lending practices. Credit risk management. Credit risk assessment. Credit risk assessment is the process of evaluating the creditworthiness of a borrower to determine the likelihood that they will default on their debt obligations. Financial institutions use a range of quantitative and qualitative factors to assess credit risk, including credit scores, financial statements, and industry trends. Credit risk mitigation. Credit risk mitigation is the process of reducing the potential losses that can occur from defaulting borrowers. Financial institutions use a range of strategies to mitigate credit risk, including diversification, collateralization, and credit derivatives. Best practices in credit risk management. Best practices in credit risk management involve a range of strategies to identify, assess, and mitigate risk, including developing comprehensive credit risk policies and procedures, monitoring credit risk exposure, and stress testing credit risk portfolios. Credit risk assessment, creditworthiness evaluation. Credit risk assessment involves evaluating the creditworthiness of borrowers and assigning a credit rating based on various factors such as income, credit history, and debt to income ratio. Quantitative approach. Quantitative approach uses mathematical models and statistical techniques to assess credit risk. This method involves analyzing financial data such as income statements, balance sheets, and cash flow statements to determine creditworthiness. Qualitative approach. Qualitative approach involves analyzing non-financial factors such as management experience, industry trends, and market conditions to assess credit risk. This method is useful when dealing with borrowers who have limited financial data available. Credit risk mitigation, diversification. Diversification is a method of credit risk mitigation that involves spreading credit risk across a range of borrowers and investments. This reduces the impact of credit risk events on any one borrower or investment. Collateralization. Collateralization is a method of credit risk mitigation that involves securing a loan with collateral. This reduces the risk of loss in the event of a borrower defaulting on their loan. Credit derivatives. Credit derivatives are financial instruments that allow investors to transfer credit risk to another party. This helps to reduce the impact of credit risk events on the investor's portfolio. Conclusion. Credit risk is a key consideration for financial institutions, and understanding the different types of credit risk and the strategies that institutions use to manage credit risk is essential for navigating the complex world of finance. Thank you.